Hello, everyone, and welcome back to another Fast Five. My name is Rob Smith. We have Greg Thompson on as always, and today we are joined by our friends from Aristotle Capital Management, David Wajner and James Chu. David, do you want to give yourself and James a bit of an introduction?
Absolutely. Thanks, Rob. Thanks, Greg. We appreciate everyone's time. It's a pleasure to be here. My name is David Wajner. I'm based at Aristotle's Newport Beach office in Southern California. We're accompanied by James Chu. He's our senior portfolio specialist. So he's a investment team representative that's going to be doing all the heavy lifting here. He's based in our LA office, which is our headquarters. And together we're very excited to be here and look forward to having a wonderful conversation.
All opinions and views expressed by the speakers are not representative of views and opinions of RBC Dominion Securities, Inc. All information and opinions provided in this video are in good faith, but without legal responsibility.
That sounds great. Thanks a lot, David. James, welcome as well. So for people that haven't heard about Aristotle Capital Management before, why don't you give us a little bit of background and talk about how you started and what you guys do?
Yeah, absolutely. Our history really goes back a couple of decades where our founders, led by our lead portfolio manager for our domestic strategy, Howard Gleischer, started a firm in '97. And from that firm, utilized the underlying process philosophy that we have today. And actually, in fact, many members from that investment team coming over to our Aristotle investment team. But essentially, in a world where if we look at investing as a spectrum and we have growth on the very right, we have deep value on the very left, and we have core in the middle, our strategy certainly leads more towards that value side, but perhaps a little bit in between the core and the deep value bucket, given that we are a quality first value investor. And of course, Greg can dive into that, but want to turn it back to you before getting too much into the weeds.
Well, why don't you tell us about your process and how you sift through the market to land on the companies that complete your portfolio?
Yeah, absolutely. So what we utilize is what we call our QVC framework. And that's not the shopping channel. It's for us, if I had a research report right in front of you, it's divided into these three sections: Q standing for quality, V standing for valuation, and C standing for catalyst. And I mentioned that we are a quality first value investor. So for us, the first stage of when we look at a business is trying to understand, is this a high quality company? Essentially, the question that we're trying to answer is, does this company have a sustainable competitive advantage? Very much that Buffett Munger type of mentality. And oftentimes these companies are market leaders. They have industry leading profitability. They have the ability to generate significant levels of free cash flow that it can use to reinvest in its business. And so once we can check off this box of quality, that is where we then get into our discussion on valuation. And this is where we really differ from some of our more deep value oriented counterparts, where they're starting and ending with value. For us, value is really that middle component of our process. And so we're trying to find these great companies that are misunderstood, underappreciated, and going through some type of transformation, and as a result, undervalued based off of our calculation of its intrinsic value. From there, that's when we get into the third leg of the framework of trying to identify catalysts. We as value investors know that one of the biggest mistakes that we can make is falling under a value trap. And so to ensure that we limit ourselves from falling into these value traps, we want to ensure that there is actions or events that are currently underway and under direct company control that are in place that'll unlock value within our 3 to 5 year time horizon. So something to ensure that the needle continues to move for the businesses that we invest in.
Okay. I got a question for you, James. You talked about valuations and part of your QVC methodology. With the high valuations in the U.S. market right now, and the uncertainty coming from many angles down south, are you guys looking at more companies outside North America?
Yeah, I would say that this is certainly a prudent question given the market dynamics and also given certain levels of currency normalization that we are seeing in the market. And my answer is twofold. One is this is our large cap value strategy. We have a team that manages this strategy and also an international and global that I believe are not quite available on the platform yet, but I know David's working hard to get them onto the platform. We are certainly seeing significant opportunities on the international front. And I would say we are also seeing a lot of interests from clients on our international portfolio. With that being said, for this domestic portfolio, I wouldn't say that we're looking for more international businesses because within our mandate, we can invest up to 20% in international companies. However, they're of one of two flavors. One is they're US businesses that are domiciled outside of the US because of tax purposes, or two, they're international businesses that have significant exposure to the US market. So think about the likes of a Michelin tires, think about the likes of a Sony, PlayStation, Sony Music, Sony Pictures, of course, very prevalent in the United States. So with that being said, for this particular strategy, there isn't more international businesses that we're looking at. I would say that we recently, in the last year, added Total, which is a French oil and gas conglomerate that has significant renewables exposure here in the US. And we sold out of Michelin more recently. So there aren't more opportunities, but we are finding those opportunities in our international portfolio.
Okay. One more for me here, and maybe just taking a step back. You talked about your QVC again methodology that kind of tells a story of your bottom up analysis. But when we look at the macro landscape, do you and your peers at Aristotle have some thoughts on the general maybe U.S. economy and for that matter what's going on globally?
Yeah, this is always a tough question to answer, given that we all want a crystal ball, but we don't have it, right? But nevertheless, from a quarter ago, it does seem like a lot of the headline risk or the worst headline risk seems to be somewhat past us. And I reserve the right to say somewhat because there is still a lot of uncertainty out there, right? When you think about trade negotiations, you think about the agreements in place with the likes of Japan, the likes of Korea, the EU, the UK, but a lot of that is tentative. And the implementation of that is still yet to be seen. We already see a few headlines coming out of South Korea about how the structure of their investments into the US may not be as clear as once perceived. You have the resignation of the Japanese prime minister, which could then reopen negotiations with the US. And so as a result, there's just still a lot left in limbo in terms of trade negotiations. Then on the economic data point front, you have some softening labor data points, but then you also have a stickier level of elevated inflation, which could then put central banking policy in a bit of uncertainty as well. And so when we look at all of this data, for us, it's a testament of why we are always bottom up. And we are focused on business fundamentals rather than trying to predict the unpredictable in macroeconomics, right? When you have a business, for example, like Martin Marietta, where there are concerns around a waning construction market here in the US, there are macroeconomic factors that are creating significant headwinds and a lot of environmental volatility in that business, which Martin Marietta is an aggregates business. So think about getting big rocks and smashing them into little rocks for construction, for roads, for infrastructure. You see a business in Martin Marietta where the average selling price is increasing by 7.4% on a year-over-year basis. You have them securing significant levels of shipments at record levels. And so when you see fundamental resiliency, that is for us what allows us to believe that our portfolio is in a very strong position despite the macroeconomic volatility that we may see.
Okay. Well, that's a very full answer and a good one. I concur with all of that was said. So like, when do you find your style works best? When do you guys find that you're facing the extra headwinds?
Yeah, our strategy will always best perform in an environment where the macroeconomic noise is lower and there's more stability, directionality, and transparency around these macroeconomic factors. Where our strategy tends to underperform and has the most amount of headwinds is where there's these stark stylistic pivots off of macro uncertainty and market shocks. Those are the environments that a high quality value oriented strategy like ours may lag more of our deep value oriented peers. And so looking at the current market landscape, I would say our strategy is positioned quite well, given that it does look like we are slowly and surely, despite there still being uncertainty out there, leaning more towards an environment where we have a little more directionality around these macroeconomic data points.
Yeah, it still seems like we need about 3 to 6 months to see how this new trade regime, this new, like really a new world order in global trade, bears out, because these things are being brought in slowly. Some tariffs are being applied now. Some tariffs have been announced and will be applied later. How does this all feed in to the bottom line of corporations and to the consumers?
Absolutely. And if you think about Trump's first term, the biggest headline that we were constantly talking about was a trade war with China. And right now, although negotiations seem to be trending in a good direction with U.S. policymakers, I believe going to China for the first time since 2017 or 2019, something like that, it seems to be making some positive progress, but that can change at any second, right? And that would be a massive macroeconomic event.
Okay, so I have one last question, because we do try and keep these short. Okay, I have two last questions. First of all, given all this in hand, I know you guys don't do big macro outlooks, but what is your feeling with the market right now? Are you finding value? And lastly, what people think about Aristotle, and David, maybe this is a question you could answer. What should our listeners leave with? What should they, when they think about Aristotle, what's the first thing that should come to mind?
Yeah, in terms of a macro outlook, certainly, again, I would highlight that there is still uncertainty out there. If you look at data points around labor and you look at data points around inflation and how the central bank will react to it, it certainly seems like we are in a bit of a wait and see type of mode, right? Trying to digest all of these economic data points that are coming in. However, it looks like, especially with the last Fed policy meeting, we have a bit of directionality around it, right? And so if the expected trade volatility is kept at a minimum, I would say that it positions the market to then refocus around business fundamentals, where we're seeing an extremely robust earnings period and quite a few earnings periods in the last few quarters, where investors can then focus on business fundamentals.
Okay, thanks, James.
To answer your second question, Greg, a few things come to mind. One, our U.S. large cap value strategy is tier 1 rated on the RBC A+ platform. So it's a very meaningful relationship for us. Historically, our bread and butter has been institutional business. So think large endowments, pension plans, things of that nature. And what I wanted to bring up is the fact that the strategy is somewhat exclusive to DS or exclusive to the A+ platform. We don't partner with most of your major competitors for as little as $25,000 US on the A+ platform. Your clients are getting access to a strategy, and some of our clients, I won't name them, but some of the names would be names that your clients have heard of. So I think it's a very institutional type approach, but readily available on the A+ platform, but not really elsewhere. From a strategy perspective, I think it's the consistency, it's the quality first value approach, it's the broad appeal and the ability to perform in multiple market environments, as James mentioned. We have what we call our batting average. You and Rob have probably heard me talk about this many times, but why we like to focus on our batting average is it looks at our consistency over rolling periods. It takes out the end date bias. We're not just looking at the last 1 year or 3 years or 5 years. We're looking at every single rolling period. And if you look at a rolling 5-year basis since inception, we've actually outperformed our primary benchmark 98% of the time. So for us, that's a testament to our bottom-up, low turnover, long-term, very consistent approach. So a few things to leave you with, but James might have perhaps a couple others, but hopefully that resonates with your clients.
Okay, no, that's great. You know, it's nice to hear from our southern neighbors, see what they have to say about the markets going on. Goodness knows Canadians do not live in a vacuum. And, you know, the US is such a massive market. There's so many companies down there that, you know, we want to have people that their only focus is the US and companies like you said earlier, global companies that do a lot of business into the US. So we appreciate your time. We know it's valuable. And thank you again for everything. Thanks, guys.
We appreciate your partnership. All the best.
Thanks, Greg.
Thanks, guys.
Thanks, Rob. Thanks, everyone.